Let us kind of, maintain confidentiality, of course, but if you could just walk us through some of the interesting little ins and outs of one of the more interesting cases that you have handled.
Sure. Yeah, I have had, so I had a case where there were siblings involved. They owned a business. This was pretty valuable. So they were selling the business for $10 million. And they were primarily interested in reducing their tax burden, right? Because the problem they're facing, so I wouldn't mind having this problem, I don't know, about 3.3 million being thrown at each of them, but they're looking at a pretty hefty tax bill because that's going to be, they live in California. So in California, they're going to get hit with a capital gains tax on that. And capital gains, because they basically have zero basis in the company. So the company wasn't worth anything when they founded it. Now they're going to sell it. And basically that's $10 million in capital gain. And capital gains tax is pretty high. So they need a way to reduce their income in that year. And so how do they do it? So you put together a charitable remainder trust. Now, here's the great thing. This can really significantly reduce their tax burden. And then they set it up. So for the next 20 years, they're receiving payouts. So they're receiving an income stream annually for 20 years. And that income stream, the way the numbers run, that income stream is going to give back more than they put into the trust. When you add up their tax savings and the income stream, they wind up ahead financially, which is beautiful. And then at the end of the term, at the end of the 20 years, their favorite charities receive the remainder.